In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, volatility remains the main headline, with Apple and tech at large leading the way. Where we stand in the markets now, we break down tech's role in the slump. Plus, New York paid $750 million to fund Elon Musk's solar factory, but Gigafactory 2 looks more like an empty Walmart with idle machinery and employees who feel like the stepchildren. And the guy who ran moonshot projects for Alphabet CEO Larry Page has launched what he hopes will be the Apple Store for doctors' offices. We'll explore the rise in tech-savvy preventative care. But first, to our top story, tech volatility, the new normal. The sell-off in momentum stocks continued a slump that began last month, with the latest blow coming from renewed concern that demand for Apple's iPhone has slowed. Apple's seen a 20% plunge from its trillion-dollar high, and the other FANG stocks are following suit. Here to paint the full picture, we've got Bloomberg's cross-asset reporter Luke Kawa with us in New York. So, Luke, walk us through the reversal that we saw today and how it fits into the broader context.
So, yes, obviously we've kind of been front and center focusing on tech's role in this sell-off, and it has been, playing the starring role throughout in the retreat. But one thing that was interesting that happened during Tuesday's session was this big reversal. So shares of companies like Nvidia, Square, and Facebook, they both opened very, very much in the red. And, at one point in the day, Nvidia was up as much as 15%. So that's the kind of move that investors, when they see it, they start to think, okay, was that a capitulation bottom? So at one point on Tuesday, tech stocks were very much leading to the downside again. And, later in the afternoon, they've recovered to pretty much trading in line with the market. So we'll see where it goes from here. But I can tell you a lot of people are focused on the price action and some of those big names as potentially indicating a bottom.
Now, we're seeing very company-specific stories in the middle of this broader pain. Apple with concerns about production cuts and iPhone demand. Facebook with concerns about mismanagement, pushback against Amazon and HQ2. How much does this have to do with a sort of broader theme versus these very specific stories?
So to be clear, everything in tech's really getting hit, but obviously some's getting hit worse than others. And to kind of look at it or depict it, I would say it's a lot like a barbell strategy that you'd talk about. What's getting hit most is the big names, your FANG heavyweights on one end, and then getting hit even worse are the recently IPO'd stocks, the stocks in the IPO U.S. equity ETF. So it's the newbies and the more established heavyweights that are really bearing the brunt of the pain. When you kind of scratch below the surface, though, and look at both realized and implied correlations on the NASDAQ 100 constituents, you do see that, we're kind of out of the throes or the panic phase of the sell-off. One would hope or one would expect if you're bullish on tech stocks. So those implied correlations and realized correlations have kind of come in a bit, and that's a sign that investors are starting to distinguish a little more company by company on the fundamentals. But on the other hand, you still have over a quarter of NASDAQ 100 constituents that are trading above their 50-day moving average. So in terms of a flush move, a capitulation bottom that some are expecting, that's something that augurs in the opposite direction, that we haven't quite got that yet.
Now, Amazon and Netflix have been hit, but still, when you look at discretionary stocks and take them out, I have this chart here in my GTV library, which shows that, really the broader stocks are suffering, even more so. But then you see them pick up more recently as Amazon and Netflix have come down. So, what's your takeaway there, especially as we head into the holiday season?
My main takeaway is that it's such a different year for judging U.S. consumer stocks. So in 2017, it was all about, all you had to do was prove that Amazon wasn't eating your lunch completely and taking away your business immediately, and you were pretty much fine. The bar to success was fairly low. Right now, a lot of those consumer discretionary companies are in the firing line on margins from a variety of front, both from freight costs, shipping their goods to and fro, and also from rising labor costs. A lot of those companies have a lot more exposure to labor costs than, say, your Amazon. So just to kind of, pick a product, XRT, which is the equal weight retail ETF, it's, habitually had more than 100% of shares sold short. Recently, before this past earnings season, you saw short interest come in a ton. So essentially, it's become a victim of its own success, where just by holding up the bar to impress investors has gotten a lot higher, and people are no longer betting on retail to fail as quickly or as much as they were in 2017.
All right, our cross-asset reporter, Luke Kawa, I know you'll continue to follow these names for us. The question is, will this continue? Will tech continue to underperform? Our next guest says tech regulatory risks are just beginning. Jim Paulson of Ludwig Whedon joins us from Minneapolis, and here in the studio we've got Bob O'Donnell, Technalysis Research. Jim, I want to start with you. We're going into a holiday season. We're going into a few weeks of big discretionary spending. There's been talk of a Santa Claus rally. Do you think that will happen over the next 6 weeks, or do we have to wait until next year to potentially get out of this?
I think the biggest thing in the room is that the U.S. economy is probably headed for a fairly significant slowdown, not necessarily a recession, but I think growth is headed towards 2% or less, and that's more than Wall Street expected for the slowdown. I think that's why this isn't just a tech event, it's an entire market event, and it goes beyond the stock market too. There's falling commodity prices, there's blowing out in bond spreads, so I think there's recession fear. But certainly what's added fuel to this fire is that the leadership, the place where everyone has money, the FANG stocks has started to really unravel, and that's probably generated more fear than having the rest of the stock market fall. I don't think we're going to have a Christmas rally. I think ultimately we might have a capitulation panic here, maybe before the year is over, where this thing goes below the overall stock market goes below the lows we hit earlier this year, and probably goes much lower and creates panic about imminent recession and the end of the bull market. I think that could be a good buying opportunity again, but we'll have to wait and see.
Bob, is the fear warranted or overblown?
Well, short term, I think it is warranted, because I think we've been living in an era where there have been unrealistic valuations for a lot of these big tech companies. And I think it's finally coming to roost. I think we have to pull back and look at this more macro level, because I think fundamentally, we've had these companies build up valuations that most people said this is just not realistic. So in a way, it's not surprising. We're getting there. We're finally seeing a mature tech industry that's being perceived not as a teenager, but as somebody in their 30s and more mature in terms of their perspective on the world. And so I think all of these things influence this. And fundamentally, these are still strong companies long term, but in the near term, I think these valuations needed to be corrected, and the industry, or Wall Street, is taking advantage of this turn down to readjust these valuations.
So, Jim, question there. Is this about valuation, or is this about the sustainability of these business models? I mean, if people aren't buying as many iPhones, or people aren't buying into Facebook, isn't that a problem?
I think it's more about the latter. I think it's more about not so much adjusting valuations as it is adjusting growth rates for the industry as a whole, as well as for these popular companies. I'm not a tech expert, but it just seems to me that the pace of innovation in technology has really slowed from what it was that really drove this. The last big thing, at least from the outsider view, is the iPhone, and the iPad was big, but eventually that just becomes a bigger iPhone, and the iWatch really has not been earth-shattering, and things like Twitter and Facebook are hugely popular, but they basically have been the same now for a period of time. And I think that the constant pace of innovation to more dramatic products that drove demand, have-to products, I think has slowed, and it really brings into question not so much valuation, but what growth rate are you going to put on a company like Apple? Is it hitting the IBM, Microsoft mature cycle where you have to downgrade that? There's also challenges to the entire internet. Who gets to decide what constitutes hate speech, or what constitutes fake news or manipulation, or is it all just free speech? Are we going to have the internet be open, or is it going to be regulated, and who gets to be the moral authority to do that? The decisions on that are greatly going to affect the business models of a number of these companies. companies, no doubt. Not to mention, how much can you use user information in reselling, for example. There's challenges to Amazon monopoly status, much like there was to Microsoft in the past. So I think there's just a number of challenges to an industry that was way overowned from an investment perspective. And when you put those two together, it's a challenge for that sector as well as the overall market.
Bob, how big a threat do you think regulation is, or is it more about, trust in these companies? If people start to fundamentally question, do I want to share my data with Facebook? Can I trust them? Well,
I do think regulation is an issue for Facebook. I'm not as concerned that regulation is an issue for any of the FANG stocks.
Despite the monopoly problem?
Yeah, I mean, I think there are issues, and I understand that there are concerns around specific areas and the rate of innovation. Fundamentally, if you look at what's going on in tech, there are actually a lot of very interesting developments, but they're taking longer to play themselves out. And the growth expectations have been what's been called back. And these valuations were based on growth expectations that could not continue forever. And so I think what we are seeing is, yes, those growth expectations are coming down, and there's a recognition that they can't possibly have continued. But there are things coming that I think there are going to be some interesting things in 2019. Foldable phones, for one. I know a lot of people have their doubts.
You're bullish on foldable phones. I'm not so sure. I'm not so sure.
Well, here's the thing. I mean, all kidding aside, the truth is the general market has been concerned with smartphones being the last big innovation. So I'm saying, look, is there a different way to think about these devices? And I actually think it's an interesting category. It brings a wow factor back in that we haven't had in a while, and it gives people a new way to consume even services, things like Netflix, on different types of devices.
Right, there you go, the foldable phone. Just for you, Bob. Bob O'Donnell of Technalysis, thank you as always. Jim Paulson, Leuthold Whedon, obviously the next few weeks will be telling. Thank you both. Coming up, U.S.-based tech companies like Apple have been on a stock price roller coaster, as we've been discussing, but it is looking even worse in Europe. We'll take a look next. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. It's been a rough go for U.S. tech stocks as volatility continues, but that pain isn't exclusive to this side of the Atlantic. Over in Europe, blue-chip tech stocks have been tumbling too, and while the Nasdaq has fallen by as much as 13% since an October record, in Europe, the stock 600 tech index, a key indicator, has fallen by even more. To help us figure out what is going on, let's get to London, where our Bloomberg opinion columnist Alex Webb is standing by. So, Alex, why is it worse in Europe?
So what happens is that the Europe Stock 600 index has a sub-component, category, which is the tech stocks. And there aren't that many of them. There are only sort of 21, I think. And that means that when there is a big movement, it's particularly exacerbated. Now, within those 21 stocks, just 2 of them account for about 30% of the weighting. And that, of course, is SAP, huge enterprise software company, and ASML, which makes machines, which in turn then make semiconductors. And broadly speaking, they've been able to keep the stocks plumped up a little bit as a group until the past week or so, when a lot of the news flow has been negative for those 2, and that's really dragged or meant that the declines elsewhere dragged the rest of the market down.
Now, there are some names on that chart that we don't know as well. AMS, which is a key Apple supplier. Walk us through the stocks that are really dragging the market down.
So AMS is by far and away the worst performer. It's a company that went very hard and fast into the components for essentially 3D sensor. Now, that 3D sensor is what Apple uses in their Face ID array of sensors. They have not met the orders that they were expecting. They've been directly impacted by the seeming slowdown in the order book for the top range iPhones. They are down about 50% this year. Now, the thing is, their weighting in the index is quite small. Now, of course, it is having a real impact. We've then got ASML, which I mentioned, which is, it's a huge company, sort of 70 billion euro market cap, but they are the maker of these machines to make semiconductors. And while they themselves haven't been performing that badly, indeed, they've raised their targets heading into 2020. The slowdown in orders from their competitors, the likes of Aixtron and, of course, Applied Materials, means that has had a carryover into their shares, and that's headed downwards. We've then got Infineon and NXP, NXP bucking the trend perhaps has been up recently, but Infineon, another company which actually supplies the automotive industry, huge exposure there, and feeling some of the pain from the prospect of a trade war with China.
Now, I know it's hard to generalize, but we've talked about how the big screen phones are a huge hit in Asian markets, especially in China. How is the European customer different? I mean, do they have tech preferences that are unique?
Well, it's interesting. In the UK, for instance, the iPhone is massive, but on the continent, Android is a lot bigger. Now, the spending on services is perhaps tapering a little bit in Europe because there is a huge amount of skepticism when it comes to Facebook, Google in particular. Now, that is partly due to the regulatory atmosphere here. There have been more measures put in place which have not only directly punished some of these companies, I think of Facebook and Google in particular, but it has very much changed the mood and the approach towards them, and therefore the willingness to engage with their platforms.
All right, Alex Webb for us in London, holding it down for us on the other side of the Atlantic. Alex, as always, good to have you here on the show. Coming up, Uber's IPO strategy takes shape as growth plateaus in the main ride-sharing business. The company hones in on 3 giant countries that are still largely untapped. We'll bring you the latest next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg. As Uber prepares to go public next year, it is gearing up to tell investors that much of its growth will come from food delivery, self-driving cars, and scooters. In most major markets around the world, it's either won or retreated, which means the main ride-sharing business is plateauing. But thanks to a more diplomatic approach pioneered by Uber CEO Dara Khosrowshahi, there are a few markets that hold newly tantalizing possibilities. Here to tell us about those markets, who else but our Bloomberg Tech Uber reporter, Eric Newcomer. So, which countries and why?
Yeah, we're talking about Germany, Japan, and Argentina, I think are 3 sort of major prospects. Japan has, one of the largest taxi markets in the world. It's proved one of the most intractable businesses for Uber. So that's an area where I think there's more sort of future growth potential than actual.
So does Uber have any penetration in Japan?
In Japan, they have, small sort of taxi partnerships in a couple of cities. And the idea is, you're going to book a taxi app on Uber. It's the ultimate capitulation. All the ideals of we're going to hold out and force UberX, our sort of peer-to-peer model, have sort of gone away. And now it's taxi market's big. We'd love to dominate that if that's our sort of way to have a, hailing presence in a country.
Then there's Germany.
Right. Germany, Uber has sort of a more developed program. In Berlin and Munich, they've had sort of black car services. They're partnering with fleets. They long ago lost their POP service, which is the equivalent of UberX, sort of the peer-to-peer model. I talked to a fleet manager who said, in America, you might say America first. In Germany, we say rules first. And that's clearly sort of the impression in Germany. So Uber is trying to sort of follow the existing rules there, which mean black cars.
And finally, Argentina.
Argentina, had this huge sort of a money transfer restriction that made it really hard to operate, bad sort of patchwork of laws. And then for Uber, a financial crisis in Argentina has really helped it because all of a sudden regulators are very concerned about getting jobs for drivers. So there's a lot more demand to expand Uber outside of Buenos Aires where it's been operating.
So these are 3 countries with high potential, but overall, isn't it a big problem that the main ride-sharing service has plateaued?
Well, yeah, growth is slowing. There's still significant growth, under 40%, but it's halved over 6 months ago. So there's still some growth, but the massive sort of growth that we've seen, is slowing. And that's why it sort of is this patchwork IPO strategy, not just ride sharing, but Uber Eats, scooters, autonomous, and maybe we'll come up with some other things. That it is a concern, but that's sort of what Uber faces as it prepares for an IPO.
Now, we talked about food delivery becoming, increasing share of the business, 17%, they say, of the business, though we don't know how much of that Uber is actually
getting. Of gross bookings, right.
But scooters are small. Self-driving cars are non-existent.
Right. I know. If you wanted to spin it for Uber, you'd say small things grow, which means that there's more potential. You see what our revenue is now, nearly $3 billion in a quarter. The fact that we have these nascent projects means we have upside. On the other hand, it just means we don't even know if scooters work. I mean, that's always the thing with technology businesses. There are a lot of signs that, in a given city, models, that these are investable businesses, but that scooters will ever generate meaningful profits for Uber is a total unknown. So yeah, I agree. It's small and uncertain.
So the question is, are investors going to buy this story at $120 billion valuation?
Right. I think, $120 billion, that's what, Uber's bankers or prospective bankers are saying it might be worth, is optimistic. But, $76 billion or, whatever the sort of latest valuation, it has hovered around that range for some time. I mean, it's real money that is getting invested at that price. So I think it's plausible, but the markets are down. We'll see. But that's certainly Uber's aspiration.
All right, Eric Newcomer, Bloomberg Tech. I know you'll keep us honest. Thank you so much. Well, the founder of China's e-commerce giant, JD.com, Richard Liu, is trying to calm investors concerned about the company's prospects in the midst of rising competition and a global trade war. Liu is also waiting to see if U.S. prosecutors, more seriously, decide to charge him over rape allegations stemming from a case involving a Minnesota college student. He said on a conference call that he will focus on new businesses and strategy. And another twist in the saga of Elon Musk and the leveraged loan he's been seeking to get for SpaceX. Bloomberg has learned that the company now has cut the size of the loan it wants by $500 million to just $250 million. Musk's closest ally on Wall Street, Goldman Sachs, was originally in charge of the deal, but Goldman balked when SpaceX wanted wide latitude to raise more debt. Musk then took the deal to Bank of America. Coming up, doctors' offices are getting a reboot with the help of AI and mobile technology. We'll explore the potential clinics of the future. Plus, Elon Musk called the third quarter the best quarter ever for solar. So why are employees calling its factory an afterthought? Why Tesla's solar business has remained largely idle. This is Bloomberg. Technology. I'm Emily Chang in San Francisco. Healthcare startup Forward wants to be the Apple Store of doctors' offices. That is, if an Apple Store can learn and get better with data, says its founder, Adrian Aoun. Aoun, Google's former head of special projects, launched Forward in 2016 in an effort to revamp the healthcare industry and re-engineer the doctor's office. Today, Forward's clinics are aiming to compete with world-class doctors, use all the tech the healthcare industry has neglected, from sensors and infrared scanners to AI and mobile apps. The company has now raised $100 million in funding, just completing a Series B, led by Mark and Lynn Benioff and Founders Fund. Here to discuss, CEO and founder Adrian Aoun. So you started this because of a family who had a health care scare. What happened?
So not the first time in my family. Every single day since growing up, I've always had this kind of looming fear in the back of my mind that I'm going to come home and one of my parents is going to kind of sit me down and tell me about something that happened to someone in my family. It started with my grandfather. It ended up with someone much closer to me. And at every single point in my life, I started to realize that healthcare is this kind of thing that just happens to you, right? Whether it's a heart attack that just grabs someone that you know, whether it's cancer that grabs somebody else. One of my good friends in middle school just one day was pulled out of school because of leukemia. And what I started to realize is that we're all just kind of these sitting ducks waiting for it to happen to us. And instead of just taking that as it is, one of the things that we're pretty good at doing in the world of technology is saying, we don't like how something is, let's see if we can improve it. Whether it's trying to solve climate change with Tesla or trying to solve drunk driving with Uber, I said it's kind of odd that nobody's doing this for healthcare. So that's why I decided to start Forward just a couple years ago to say, what can I detect that's going to happen to me or to you, ideally years and decades before it does happen?
Now, there's no question that doctor's office need a little help from technology, and it still baffles me that you can't even send a doctor an email. But when you bring in state-of-the-art AI, genetic testing, mobile apps, what does that look like at scale?
Yeah, well, the great thing about it is actually, if you think about your current doctor's office gets worse with scale, right? You kind of don't want to tell your friends who your doctor is because that makes it harder and harder to get in. But technology is the entire opposite. Technology gets better with scale, whether it's more information, whether it's more ability to invest in better and better technology. If you look at the world of technology, it's predominantly these enormous companies, right? Billion user companies like Google, Facebook, Apple. But there isn't really a billion-person healthcare system, right? In fact, the largest healthcare system out there is probably, about 10 million or so. That's roughly Kaiser's size. That's less than 3% of the United States. If Kaiser was a tech company, you would have never heard of it. You wouldn't have the app on your phone.
So the model here is you pay a membership fee, $150 a month.
Yep.
You know, what do you have to pay for, though, on top of that? What do you get for that?
Nothing.
It's not covered by insurance.
So the problem with healthcare today, if you think about it, is it's like going to the Apple store saying, oh, I really like this iPhone, taking it home, and later, 3 months later, getting a bill in the mail for $850 randomly with no insight as to what that was going to be. We said that doesn't work. What you're doing by sending these people in the mail bills later on is you're disincentivizing them from using healthcare. So Forward is a membership model, flat rate with no hidden fees, no copays, no extra for a blood test, no extra for visits, no extra for body scans, no extra for skin scans. All of this is included point blank.
Is the goal to get insurance to cover it someday?
No. Actually, we think that much like most things in technology, as we continue to invest in our technology, we'll be able to lower that cost more and more over time. So remember, the first smartphone was $800. Now you can get smartphones in the middle of India for $20. Why isn't healthcare following the same trend?
You've got 3 clinics. I know that you have one in San Francisco, or you're in Southern California, Northern California. Yep. You're opening clinics in New York. You've been seeing a lot of patients due to the air quality and the fires. You know, what are you seeing there?
So first, it's worth noting we actually have about 5 clinics now.
5 clinics in 3 areas is what I meant.
Exactly. So the fires are a really great example of where the healthcare system fails us. Think about what you do today, right? You go about your life, you're inhaling this smoke, you wait for it to get super bad, then you start having problems, you become sick, whatever it happens to be, then you call the doctor and try and get in. Isn't that too late? So what we did with all of our members is we proactively reached out to every single one of them and said, can we give you smoke masks with filters, or can we just give you advice? Maybe don't work out outside. Maybe try doing X, Y, or Z. Now, what does this allow us to do? This allows us to prevent things as opposed to being reactive. And that's the problem. The healthcare system today, and frankly, the insurance system today, is very reactive. They don't want to spend the money. They don't want to invest in your health. So they want to wait until the thing already.
Well, the counter argument is that some of this preventative healthcare tells you things, oh, you're healthy. Great.
That's fantastic.
You don't need any health care.
That's fantastic.
Good to know.
That's an almost absurd notion. What does this mean to be healthy? We're all going to die of something at some point, right? So why don't we start addressing that? Look at me. I look young and healthy, but I tell you what, my genetics tell me that in about 25 years, I'm very, very likely to be developing heart disease and probably have a heart attack. So even though I'm healthy, I should be working on that now. I shouldn't be waiting decades to go deal with that.
Now, I have to ask you about, you ran special projects for Larry Page, who's got a lot of special projects. You know, what was that like? And what do you think about what Google is going through now with the harassment, the way that he personally has handled some of these misconduct allegations?
So let's take those as 2 separate issues. So the first thing, what I learned at Google was basically this notion of taking technology and applying it to different industries. So when I founded Sidewalk Labs, we said, what can we do by taking technology and applying it to the built environment, the urban environment, right? And what I said with Forward is, let's take those same technologies, connectivity, things that get better with scale, data analytics, AI, the latest in mobile access. Let's take all that and let's apply that into the world of healthcare and bring it into the modern era. Now, to your second point, I mean...
Right, let's not be over-focused on the future when we really also have to focus on the present.
Absolutely, absolutely. I mean, both are super important, right? When I look at Google kind of culturally, to your question, I think, you know, when I was there, I worked with some super amazing people. I mean, it was just across the board, really, really wonderful people. But it's very clear that that it's hard to maintain culture, and one, especially as you scale and you become so large. So one of the things that we've tried to do at Forward is really build that in from day one. So I'm super proud to say that our company is actually 60% female. Our company has tons of representation of underrepresented minorities. And one of the things that does is it brings more diversity to the table, allows you to get ahead of these problems. So the same way that we want to be preventative on healthcare, let's also be preventative on culture.
But where do you think Google went wrong with its culture?
Yeah, so to be honest, I wasn't there long enough to tell you. I wish I had those answers. I'm probably not best equipped for that.
All right. Adrian Aoun, fascinating what you're working on. We'll continue to watch. Founder and CEO of Forward.
Thank you so much.
Thanks for stopping by. Well, Amazon reportedly is bidding for the 22 regional sports networks that Disney will divest as part of its Fox deal. CNBC says that includes the Yes Network that broadcasts New York Yankees games. Blackstone Group and the Yankees are also bidding on the New York network. Coming up, has Elon Musk forgotten about his solar factory? Why critics are saying the Tesla CEO hasn't done enough for Gigafactory number 2. Plus, Weight Watchers is an iconic American company, but it's got a new name and a new approach to doing business. How does tech fit into that vision? We'll find out. This is Bloomberg. In Buffalo, New York, there is a 1.2 million square foot factory. Inside it, a Tesla solar factory. The Gigafactory 2, a sort of sequel to its enormous battery plant. But while Tesla's battery plant employs more than 7,000 people, employees describe Gigafactory 2 as an afterthought, Tesla's stepchild. Today, Gigafactory 2 resembles an empty Walmart center filled with idle machinery and one sole production line. And while Model 3 production at the Fremont factory in California is up to 4,500 cars a week, Buffalo's solar plant in New York is only producing enough panels for 3 to 4 houses per week. And despite his original enthusiasm for solar, Musk has yet to visit the factory himself. Here to discuss, Bloomberg's Brian Eckhouse, who toured the factory. So, Brian, take us inside. What did you see?
It's a really fascinating sort of vision. You go to Buffalo and you go from downtown to like the waterfront, and there's all these empty lots, buildings that are brick buildings that have sort of lost its strength. And you walk inside, and it's this beautiful, glistening white box, and there's one line production for Tesla. It's also Panasonic on the other side, and the line is coming along. It's partially automated, not entirely, and people that are working there, but there is also a lot of empty space, as you said.
So what happened?
It's really fascinating. Elon Musk said 2 years ago that solar was really important to bringing along Tesla, that energy was really critical to meeting his master plan part 2, as he put it. In fact, 2 years ago, he had this big unveiling of the solar roof, this beautiful glass tiled roof in LA at Universal Studios. And unfortunately for Tesla, though, 2 years later, there have been very few that have been produced and installed. There is appetite for it. 11,000 people put down deposits by May, but so far not that many people have it installed.
So what is the outlook for the solar roof at this point, and what is Elon Musk saying about it?
Yesterday, Elon tweeted that solar roof is one of his priorities. And on the last earnings call, he said that there has been, it's advanced, and Tesla is seeing more profitability with solar. And going to next year, they're hoping to ramp it up. They hired a man from Amazon to run energy, and his goal is to scale it up. And Tesla says that they have, quote, iterated it to the point where it's getting close to being ramped up pretty strongly, and it's a 2019 goal of theirs.
All right, well, we'll be watching to see if he pays his so-called stepchild a visit. Bloomberg's Brian Eckhouse, thank you so much for sharing that report with us. Well, Alexander Weigers is a forgotten figure in Silicon Valley history. He was an artist, a blacksmith, an aerospace engineer, and more, a true Renaissance man. But if one art dealer has his way, he won't be forgotten for much longer. Bloomberg's Ashley Vance has the story.
This is the story about a forgotten genius, a gifted sculptor, artist, and modern-day Leonardo da Vinci, whose UFO-like invention was the realm of pure science fiction. But it's also a story about this man, his fixation with the past, and living on borrowed time. This is the guy he wants everyone to know about, Alexander Weigers.
This is probably the most photographed Weigers so far.
Randy discovered Weigers in 2008, when for the first time, his sculptures were put on sale. Randy snapped up the lot. As an art dealer, he had dreamed of hitting it big by finding an unknown artist and making him famous, and figured that Weigers was his man. During his hunt into Weigers' life, Randy discovered something extraordinary. Hand-drawn designs for an exotic aircraft dating back to the 1920s. Alex appeared to have invented the very first flying saucer.
That was an amazing find in itself. When I saw the blueprints, it was undeniable that he was the creator.
Weigers called his futuristic flying machine the Discopter. Designed to take off vertically and float on a cushion of air, it was a unique concept, and one he thought cities of the future would make full use of. Weigers patented the Discopter in 1944, and then tried to sell it.
He starts sending all of these letters to all kinds of companies, telling them about his invention.
As word of the Discopter began to spread, Alex felt the U.S. military stole the idea. It was an accusation they denied. But for Weigers, evidence of the theft was there for all to see, as images of his flying saucer seeped into popular culture, influencing everything from architecture to cars and movies.
A two-seater ready soon may be the car or chopper of the future.
There's this whole flurry of stories. Weigers, first with saucer. Dutchman says he designed flying saucer 23 years ago, the man who invented the flying disc. He didn't really seem to be after compensation as much as recognition that he'd done something important and wanted a bit of credit for it.
In Weigers, Randy discovered a kindred spirit, a man who chose to live by his own rules and who created a legacy using his own two hands.
What would you say to Alex if you saw him now? I wondered if you had dreamed about that moment or anything.
I did dream about meeting him.
Yeah?
Figured it was the spirit of Weigers, basically telling me I'm doing the right thing and I should continue with my mission.
Another fascinating piece from Bloomberg's Ashley Vance. Still ahead, Weight Watchers is no more. Instead, now rebranded as WW, the company is looking to woo new users with a new digital strategy around the globe. Our conversation with President and CEO Mindy Grossman is next. This is Bloomberg. The company once known as Weight Watchers is in full rebranding mode. Now, WW, as it's called, is looking to 2019 as the year it tries to capture the holistic wellness space. Key to that is partnerships with startups like Blue Apron and a digital strategy targeting beyond its base as WW reaches out to young moms, dads, college kids, and more. We spoke with President and CEO Mindy Grossman.
There are so many avenues of work that are happening right now. And again, if you just look at the last year, we launched Freestyle, which is the best program and most efficacious program in the company's history for eating. We launched FitPoints 2.0, which took the science similar to what we do in nutrition and used it for customized activity. We are integrating active audio fitness within our app. We integrated Headspace for content. Very excited about our rewards program that has been in work for almost a year, just launched 4 weeks ago. Doesn't reward you for spending money, rewards you for everything you do on behalf of your health and nutrition, and you win wellness wins. And we're already seeing an increase of 20% of nutrition tracking and 80% of activity tracking. And then Connect Communities just launched in Canada. It's going to be rolling out to the rest of the world, and that's for people to be able to find and form. So we have a whole universe of activations that not only will happen between now and the end of the year, going into 2019, when we really do the big brand relaunch, but even from there, they're constantly innovating, and we have teams around the world, big teams in New York, in the group out here. We're looking to double our tech footprint out here. So it's been pretty exciting.
So there was a big run up in the stock, and the shares are down significantly since June. What do you think investors aren't getting?
You know, we have a lot of new investors, new coverage, and I think it's a matter of really educating everyone on the seasonality of the business. And I think that's been the biggest confusion. And you really need to look at our member base year on year versus quarter by quarter based on the business that we're in.
Because January 1st is the big day.
Well, that's certainly, you know, we're kind of wellness 365 now, but there's no doubt that January is just Pavlovian. People decide they want to get healthier. But it's important to note that our results this year have been fantastic. Our subscriber base is almost up over 25%, even in the last quarter. Sales at 17% year to date. Operating income significantly above where we've ever been. And we've hit every single quarter all-time highs for the company. So the team has done an incredible job, and it's a matter of just getting people to understand the trajectory of the business. I think the second thing is, as much as we've announced what has been launched and is launching, the reality is that the true brand launch and everything inherent in what we're going to be offering to the customer is really happening at the beginning of 2019, and that's what we've been preparing for and activating. And what we've already activating, we're already seeing the impact on retention and the impact on recruitment.
So you've got some new partnerships. You mentioned Headspace. There's Blue Apron. You've got, you know, integration with the voice assistants. You know, how do you think this will bring the business forward?
So if you look at where we've prioritized, it's will it recruit, will it retain, and will it elevate the brand? And when you look at partnerships like Aptiv and Headspace, we're providing even greater value for our members. Similarly with the rewards program, which we know will have an impact on retention. And then certainly with this move from not just being weight loss, but giving people a whole wellness platform, that's a very big recruitment message and allows us to have a much broader range of partners. So what we said is we want to own the healthy kitchen. And so our partnership with Blue Apron, we launched the first WW Freestyle Cafe in Barclays Center with Kat Cora. We have a whole line of kitchen products. Every single food product that we make, you don't eat Weight Watchers food. You can eat anything you want on Weight Watchers. But the food products we make in snacks and things like that have been 100% reformulated to reflect a healthy living brand. And that will be launched in all our direct channels in January. And then our first branded store for all our products will launch on Amazon at the beginning of February.
You're also a global company. You're in 11 countries. I mean, are there any plans to expand beyond
Yes.
that?
So what we've said, you know, in February, when we came out with our Impact Manifesto and our new purpose, we inspire healthy habits for real life. people, families, communities, the world for everyone. And that means the world. So today, about 70% of our business is in North America. Next three largest markets, UK, Germany, France, other markets in continental Europe, Australia, New Zealand. We definitely have a big opportunity, and there's a great need in both Latin America and Asia. So what we said is we will be doing the strategic work on what market entries will come next, and that by the end of 2020, we will start the development in new markets while we're building the markets we're in.
Our conversation there with WW CEO Mindy Grossman. Well, NASA is planning a safety review of Boeing and SpaceX, the two companies it has hired to fly astronauts to the International Space Station. This according to a report from the Washington Post. The move was prompted by Elon Musk smoking of marijuana and drinking whiskey on a podcast, which reportedly rankled some top officials at NASA. The review would involve a months-long assessment and hundreds of interviews to assess workplace culture at both companies. And that does it for this edition of Bloomberg Technology. We are, of course, live streaming on Twitter. You can check us out at Technology and follow our Global Breaking News Network TikTok. On Twitter, I'm Emily Chang in San Francisco. This is Bloomberg.